Welcome back to the Property Apprentice podcast. I'm your host, Debbie Roberts, and today we have to talk about some very big news for all of us in the property investment space. According to a Business Desk article published on September 10th, 2025, Inland Revenue Department, IRD, just released some figures that show how their tax investigations into our sector are paying off big. I'll be linking the full article in the show notes and the description area below so you can read the full text. Tell me your thoughts in the comments. In the fourth quarter alone, the IRD found another $75 million in income tax and GST from property investors and developers, and that's not the half of it. This brings the total for the financial year to a staggering $228 million of undeclared income. That's a massive 46% from the previous year. Now, you might be thinking, what's going on? Why the sudden surge? Well, it all comes down to a clear government strategy and some new funding. The IRD received $35 million for the year from Budget 2025, on top of the ongoing $27 million a year from Budget 2022 to ramp up their tax compliance efforts. The expectation is that for every dollar they spend on this, they'll receive a return of $4 in the first year and $8 from the second year. That's a serious incentive to go hunting for discrepancies. I've got a detailed breakdown from the IRD that shows exactly where this $228 million came from, and the numbers tell a fascinating story. The biggest haul by far came from GST. The Inland Revenue Department uncovered over $102 million in discrepancies from 475 closed cases. Look at that average per case. That's a whopping $215,537. This shows that the IRD's focus is on developers and property flippers, and they're serious about it because that's where large GST discrepancies are likely to be found. The next largest haul was also from developers, with $92.2 million in undeclared income across 567 closed cases. Their average bill was also significant at $162,753. This confirms that the IRD is going after the big players and finding large sums of undeclared income from those building and selling property. Third on the list is the Bright Line test, which accounted for just over $22 million in discrepancies from 344 cases, many of whom were likely to be from property flippers who didn't know the rules. The average tax bill here was $65,083. Finally, the smallest portion of the total, but still a significant amount, came from rental property owners with $11.4 million in discrepancies from 485 cases. The average here was $23,705. What this tells me is that while there are a lot of individual cases for rental properties, 485 closed cases with another 273 still open, the average amount of undeclared income is much lower than for developers and those with GST issues. So while the IRD is cracking down on everyone, they're clearly getting the biggest return on their investment by targeting the high-value cases in the development and GST space. From my perspective as a financial advisor, these figures should be a massive wake-up call. It's not about being a bad landlord or a tax evader. It's about making sure that your house is in order. The fact that the IRD is now leveraging significant funding to ramp up their audits and use data to more quickly identify discrepancies means that you cannot afford to be complacent. The New Zealand Property Investors Federation spokesperson, Matt Ball, made a great point. People should not be evading tax. The reality is, though, that with over 304,000 taxpayers earning income from rental properties, the IRD is right to be watching closely. My advice to you, our listeners, is to be proactive. Engage with a qualified accountant who understands property tax. Don't wait for the IRD to contact you. Make sure your records are immaculate, your expenses are accurately documented, and you fully understand how the Bright Line test and interest deductibility rules apply to your specific portfolio, or talk to your accountant before you look at selling something. The Auckland Property Investors Association's Serena Gibbons said it well. Unwillingness or inability to pay tax just isn't the theme we see with their members, she said. This suggests that the issues found by the Inland Revenue might be due to a lack of knowledge rather than a deliberate attempt to evade. The IRD's crackdown isn't a surprise. It's a feature of the current government's policy, and it's here to stay. Property remains a key focus for them, so we can all continue to expect greater scrutiny. That means now's the time to get on the front foot. I remember a statistic from a few years ago that showed for every dollar IRD spent investigating, they bought in $5. And this is just property related ones as well. And I suspect that with the number of changes that we've seen in property tax over the past few years, that's likely to be even more beneficial for the IRD now, as many property investors, developers and flippers fail to keep up to date with the tax changes. And as the Inland Revenue expects themselves, next year they could be bringing in $8 for every dollar that they spend investigating. Look, unless you're an accountant yourself with a thorough understanding of property tax rules, I highly recommend that you do not attempt to do your own tax returns. There's also some other issues discussed in the article which I think warrant further discussion today. One of them is the mention of cash flow and finance anxiety as hurdles by RPM members. This is a common theme in a market with high interest rates and high compliance costs, like we've seen over the past few years. My advice here is to treat your property portfolio like a business. Have a dedicated cash reserve for unexpected expenses whenever possible, and this could be available funds in a revolving credit facility, for example. Regularly review your budget and your rental income to ensure that you're on track for reaching your long-term goals. Stress test your ability to pay your mortgages at above average interest rates, for example, at 7% or 7.5% on interest-only terms, as well as principal and interest, at the point when you purchase the property. And if you're using equity to fund the deposit, you need to be stress testing your ability at 100% lending. A resilient property investment portfolio is one that can weather a few storms. Serena Gibbons' insight on the trade-off for favourable policies like restoring interest deductibility in exchange for a crackdown on compliance is something I agree with. It's designed to bring more certainty to the market and have everyone paying their fair share in tax. However, I suggest that you can't rely on favourable policies alone, since these can change depending on the government's priorities, regardless of which political parties form the government. You must now also factor in a zero-tolerance approach to tax discrepancies. This will benefit professional, well-managed landlords and potentially also help to improve some of the negative feelings that some people have towards us as a group. We want to see less of the bad landlord stories in the media because they damage the entire industry's reputation. The Bright Line test is a perfect example of policy targeting. It's designed to catch speculators, in other words, property flippers. However, it's crucial for long-term buy and hold investors to also understand the rules of Bright Line so they don't get caught out inadvertently, especially if they sell a property within the 2-year Bright Line period. Even if you've been a buy and hold investor for years, understanding these rules is critical. As APIA has shown, regular tax presentations are key to improving knowledge among property investors. I can't stress this enough. And it's one of the reasons we also have a great team of property accountants that we recommend our clients to. And they're also involved in the training sessions for our clients as part of our lifetime coaching program. Your best defence against an IRD audit is a great team of professionals, including an accountant who has a thorough understanding of property tax. You might have an accountant who's great for your business, but if they aren't a property investor, they might not know as much about property accounting as you need them to. And they're not going to cover the cost of unpaid tax if they make a mistake. That's your responsibility. That's all for today. I hope this has been helpful and an informative look at the latest tax news and what it means for you. Until next time, stay compliant and keep learning. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.